Okay, hello and welcome everyone to this latest ESCoE economic measurement webinar. Today we're very happy to have James Sullivan, who's going to be talking about the pros and cons of consumption and income-based measures of economic well-being. Jim Sullivan is the professor at University of Notre Dame. His research examines the effectiveness of anti-poverty programs at the national, state and local level. He's the founder of the Wilson Sheehan Lab for Economic Opportunities, which he currently directs. So Jim's going to talk for 45 minutes, so until 1:15 UK time, at which point we'll have the opportunity to answer your questions. So if a question occurs to you either then or during the talk, if you put it in the Q&A box, then at the end I will sift through the questions, I will pick them, and if we pick your question, you'll be unmuted and we'll be asked you to state your name and your affiliation, and you'll have the opportunity to ask your question. Just to remind everyone, this event is being recorded, so bear that in mind. Okay, but now, without further ado, over to Jim. Jim.
Great. Thank you, Peter, and thanks for inviting me to present in this webinar. I'm excited for this opportunity. It's kind of exactly the kind of audience that I'd like to have to share this research with. I thought I might start by giving you a little bit of an outline of my plan for my comments. So I'm going to start by considering the strengths and weaknesses of income and consumption as measures of economic well-being. And in that discussion, I'll consider both the conceptual issues, pros and cons for income and consumption, as well as measurement issues or data quality evidence on the merits of these two measures. And then I'm going to look at and show you some evidence of how these different measures of economic well-being differ in terms of a little bit on levels, but mostly changes over time, focusing on measures of poverty and inequality. And then lastly, I'll make some comments about where this research is headed now, because there's a fair amount of other work in progress. I should make a couple of notes or caveats before I dive in. The first is that this is going to draw on a large number of papers, so I'm not presenting a single paper here. This is really work, and I should acknowledge Bruce Meyer from the University of Chicago, who's been my co-author on all of this work. And really, when I started to look at it, it goes back 20 years now. And so it's a mix of papers, and several other co-authors have contributed, and I'll try and give credit along the way. Some caveats that I'm going to focus on income and consumption-based measures of well-being here. Those are unidimensional measures, and this is not to say that those are necessarily preferred or should be preferred to multidimensional measures of economic well-being. I'm aware that there's a lot of work going on in that space, and I think arguably the UK and much of Europe is well ahead of the United States on that. There are multidimensional poverty measures and measures of economic well-being coming out of the World Bank, the United Nations, and Oxford and elsewhere. There is some attractiveness to unidimensional measures in one, their simplicity, two, policymakers' capacity to digest information, but also maybe because we've been collecting these for a long time, it allows us to say some things about changes over long periods of time. But I did want to acknowledge that this doesn't mean that we necessarily think that these unidimensional measures are the way to go. They are, particularly in the United States, the most commonly used. The other comment that I'll make, or caveat at the start, is that nearly all the evidence that I will present is from the U.S. Much of what I will present is relevant elsewhere. Some of that work has been done, and I know that there's a lot of work going on internationally as well. But the evidence I'm most familiar with and that I've been working on is for the U.S. Okay, so let's start by thinking about consumption versus income conceptually. And in a series of papers, Bruce and I and many others have made these arguments, so that they're not necessarily new. Within economics, I think these arguments are pretty standard. One argument in favor of consumption is that it's more likely to reflect permanent income. Now, I should qualify that consumption is not necessarily permanent income, but it's more likely to capture long-run resources due to some families' ability to borrow and save, and therefore is going to better reflect economic well-being than, say, a measure of current income, which may not accurately reflect well-being if families are borrowing or saving. Thinking beyond permanent income, consumption can incorporate the consumption of durables. So if you own your home and own a car, that could be the service flows from those durables could account for a large fraction of your overall consumption. And so a consumption measure will capture that. That is a quick nod to that when I talk about economic well-being, I will be thinking about consumption as opposed to spending. And I'll try to be careful about using those two different terms. Spending is what the surveys collect information on directly, but we can construct a measure of consumption by calculating the service flows from durables. Other advantages conceptually for consumption is there are certain aspects of public policy that consumption will capture to some extent that income not necessarily will. So think of providing public health insurance, for example. If the government implements or expands public health insurance, that frees up resources for households to spend on other goods that will be reflected in a consumption measure, but doesn't necessarily affect income. In general, providing a safety net, providing some insurance for a rainy day could be reflected in consumption behavior, not necessarily in income. Along those lines, access to credit. If you have access to credit, then it allows you to spend more. Some of you might be worried about overspending, but on that regard, if you're overspending and can't pay your bills, then you lose access to credit, and eventually you would have to tighten your belts, and we would again see that in consumption. And none of that necessarily would be reflected in income. And also, if you think about changes in things like that might capture long run ability to consume, like asset prices. If there's a sharp decline in your housing price or your investment portfolio, one might adjust their consumption behavior, even if they haven't lost their job or it affects their earnings or income. This is not to say that consumption is a perfect measure of well-being. There are many limitations, but in most cases where there's a limitation for consumption, that's also a limitation for income as well. Some have noted conceptual advantages of income. You can go back to Atkinson's work in the early 90s, noting that individuals can choose to have low consumption that may not directly affect their well-being or utility. But it's also important to note that people make choices that determine their income when they choose human capital investments, the employment, occupation, et cetera. The consumption's not going to incorporate the utility gains from bequests or bequest motives if families are saving to pass on to another generation. But there again, income's not going to capture that either. And for much of what we're going to focus on, we're thinking about the differences. I'm going to highlight differences at the bottom of the distribution where things like bequest motives are not as salient. So those are just kind of some comments on the conceptual differences. I'm going to go a bit deeper dive into issues related to data quality. So what I'm gonna kind of characterize this maybe a little bit more provocatively as three myths about consumption data. And I characterize it this way because when Bruce and I first started doing research using consumption data and arguing that it's going to provide a more accurate picture of what's happening to households, particularly at the bottom of the distribution, we received a lot of pushback criticizing the quality of consumption data. And so that pushed us to do a fair amount of research investigating the quality of consumption and income data. That was not, originally part of my research plan to get into data quality issues, but it turns out you can't really get into this literature without taking seriously these concerns. And so let me kind of characterize the three myths that we have encountered in talking about this research. One is that income is just more accurately captured in surveys than consumption, arguing that maybe income is easier to report. Do people really know what their consumption is? A counter argument there that might be true for households whose income predominantly comes from earnings and they're being surveyed right around the time that they're paying taxes, so they know their annual earnings. But for other households that receive their income from many sources or from particularly those at the bottom of the distribution, when the income sources are sporadic, unpredictable, and varied, it might be much harder to report income. On the flip side, consumption. It might be hard to remember how much you spent on going to the theater over the last 3 months, but if you know what your rent is and how much you spend on a typical week at a grocery store, and you know whether or not you own a car, we're getting to a large fraction of your consumption portfolio, particularly near the bottom of the distribution. Another myth that I'll talk about is that just looking at consumption by itself, that it's measured poorly. So I'll show you some data on that. Related to that, I'm not going to go too much into how we capture consumption surveys, but I will show you evidence of what we measure in terms of spending when we capture it in a diary versus a recall survey. And then so let me start by talking about the first myth, which is that income is more accurately captured than consumption. And I'm going to push back on this myth by showing you some data on income and consumption that maybe calls into question this conclusion. And in particular, if you look at the bottom and look at the bottom of income and expenditures, it's pretty clear that low percentiles of expenditures greatly exceed low percentiles of income. And so let me kind of just show you some data. And here, I'm going to do my best to remember that I have a lot of acronyms that are probably more familiar to those in the US than the UK. But feel free to jump on or send a chat message if I fail to point it out. So I'm going to show you income data from the CPS. That's the Current Population Survey. It's the primary demographic and income survey in the United States. It's the one that yields official statistics for things like unemployment, annual poverty rates, and measures of inequality. The CE survey is the survey that I'm going to use to present evidence for spending and consumption. That's the Consumer Expenditure Survey. It is a large nationally representative survey of households in the United States that designed to capture most of out-of-pocket spending of households in the United States. It's used to construct the weights for our price index, and is the primary source of data for total consumption when researchers are using those data. So all I do in this figure for a series of years is look at percentiles of the distribution of income and then of expenditures. And kind of the main point that I want to emphasize when looking at percentiles of income and percentiles of expenditures is that when you look at the bottom, spending exceeds income by about 44%. And if we also have some research that looks into saving and borrowing to see if this is just consistent with saving and borrowing. And it just doesn't, for those at the bottom of the distribution, it doesn't look like there's enough saving and borrowing to account for these differences. To make it more stark, let's look at families at the bottom of the income distribution. So here I'm doing kind of the same thing. This is mean income and spending below given percentiles of income. So again, focusing at the very bottom. what we see here is average spending for households in the bottom 5% of the income distribution as compared to average spending for households, average income for the bottom 5% of the income distribution versus average spending for the bottom 5% of the income distribution. And the spending exceeds income by 830%. And you'll note, some of you might note that, well, these aren't the same families because I'm using two different surveys. We can do this analysis within the consumer expenditure survey where we have measures of income, and you get similar evidence. And so it's very clear when you look at the very bottom of the distribution within families, these families, the bottom of the income distribution, these families are far outspending their income. Now, here's where I'm going to give some nod to the UK because I want to emphasize the point that this isn't unique to one particular data set in the US or even data in the US. Research from other countries has also noted this. And so this is an Economic Journal article by Brewer et al. That uses the low cost, let me see, it's the UK Living Costs and Food Survey. And what they document here, so the dark line is median income and the lighter shaded gray is median spending. And so it's median income by spending, and then this is median spending by income. And so you see those with low income also have low spending, and that kind of grows. But if you look, the anomaly or the puzzle as they characterize it is those with low income have high spending. So that and then you see that declines a little bit and then starts to rise. So what's going on? They characterize the puzzle as what's going on at the bottom. How are these households with very low income have quite high spending? They characterize this, what I now learn you all call a tick mark, and they're very nice to say you North Americans call it a check mark. But this is the anomaly in the data that they point out, and is very consistent with what we're showing in here when we see that for the bottom of the income distribution, we see high spending relative to income. Again, researchers looking into this that looks at assets and debts has, it suggested that borrowing and saving can't explain that difference. There's some interesting research by Tom Crossley and others that looks at Canadian data, and when they re-interview households whose spending exceeds income, the typical explanation is that they have failed to report all their income, not that they've over-reported their spending. So that alone doesn't validate consumption relative to income, but does call into question the validity of income, particularly at the bottom of the income distribution. So low percentiles of expenditures greatly exceed low income. Then to dig further on this, we look at, well, what is more strongly associated with other measures of well-being? So here I'm going to look at, we're going to construct a measure of consumption and look at a measure of income and just ask the question, if you have very low consumption, what does other indicators of economic well-being look like as compared to having very low income? Does it look like you're worse off if you're in the very low income group, or if you're in the very low consumption group? Now, this is a little bit unsatisfying to do because we don't have a data set that has all the measures that we want: income, consumption, and other measures of economic well-being. Bruce and I, in a series of papers, have looked at many different data sets, many different measures, and I'm just going to present one table to give you a flavor of what we're finding. The general takeaway is those that have very low consumption look much worse off than those that have very low income across a number of different measures. What we'd love to have is measures of economic hardship, consumption, and income, and that those in the US at least, it's hard to find good data on all three measures in the same data set. So here's kind of a summary of that of what we found when we do that. So in this column, the first column, it's looking at the consumption poor, and then these are some observable characteristics that might capture economic well-being to some degree for the consumption poor. And then we do the same thing for the income poor. And then so that you can quickly kind of assess this, does this comparison favor consumption or income? In other words, having health insurance. We think that having health insurance is a positive indicator of economic well-being. You're much less likely to have health insurance if you're in the consumption poor group than if you're in the the income poor group, and therefore this measure favors consumption. If you look across a lot of different indicators of economic well-being, you see that predominantly the pattern is that it favors consumption. In a broader set of measures, we get about 21 out of 25 measures within the consumer expenditure survey that favor consumption. The other point that I'll make is that the further you go down the distribution, the more pronounced this difference is. So if you go to, say, extreme poverty or deep poverty, say 50% of the poverty line for consumption and income, the differences are even sharper and more strongly favor consumption. That's just kind of consistent with the other evidence I showed you, that the further down the income distribution you get, the less likely it appears that the income is accurately measured. Okay, so that's just comparing other indicators of economic well-being. Consumption is more strongly associated with these other measures of well-being. The other is that so we look at other evidence of income being accurately reported at the bottom. And we're going to pick on income here a little bit, and we will acknowledge that it's just a little bit harder to pick on consumption because we don't have the same independent comparisons to validate consumption or spending the way we do income. So in particular, we have administrative data that collect a lot of information about income that is also covered in surveys. And so what we do is use that administrative data to validate. Now, later on, I'm going to talk to you about how we are linking the surveys to administrative data to get the actual administrative data report of an income source and what that person or family reports in the survey. Right now, we're just going to look at aggregates. And so let me, by way of one slide, let me kind of walk you through what we do here. And this is my biggest violator of using acronyms, US specific acronyms. So I will try to walk through this so people can see. So what we're doing is comparing total spending or total receipt of a government program that, as reported in a survey, to total spending for that program, in other words, dollars given out as reported by the federal government. So these are major government programs in the United States. So AFDC TANF, that is the cash welfare program, the FSP food stamp program, it's now known as SNAP. This is Social Security. This is disability. SSI is disability, a certain disability for low-income individuals in the United States. Supplemental security income. This is our unemployment insurance and workers' comp. And these are different, large nationally representative surveys in the United States. I already told you about the current population survey and the consumer expenditure survey. American Community Survey is the long-form version of the census that's now administered every year. And the Survey of Income and Program Participation asks more detailed questions about government programs and other income sources. So what I'm reporting here, the proportional bias, is the numerator would be the total dollars weighted up. So the total dollars reported in the survey and the denominator is the total dollars the government it gives out, and then -1. And so for example, let's focus on the CPS just to kind of give you the general story. 50% of dollars given out in welfare payments by the US government is missed in the CPS. Over 40% of food stamps is missed. It's about 50 about 32% of unemployment insurance and about 54% of workers' comp. So a large fraction of the dollars that are given out through government programs is simply missed in these large nationally representative surveys. And this is the survey that the CPS is used to calculate our poverty rates and inequality and other indicators. I'm going to come back to this underreporting later when I talk about linking it to administrative data at the micro level. But one thing you can quickly see a problem here is that using the CPS, or really any of these surveys, to measure the impact that these government programs have on economic well-being, say how does it lift individuals out of poverty, is going to significantly understate the impact of these government programs simply because they're significantly underreported. And the other key takeaway is this true across a lot of different programs and across many different surveys. One particular point maybe to note is that it's less pronounced for Social Security, SSI, and DI. These are programs that are more permanent in nature. Once you're on them, you receive basically the same payment every month indefinitely. And so perhaps it's not surprising that those responding to surveys are more likely to remember that they receive it and that they and to report the dollars more accurately. Still, I think a lot of work to be done as to why we see this underreporting, and in other work that Bruce and I and others have done, we show that this underreporting has only gotten worse over time in these surveys. And there's here again internationally, at least in terms of just non-response rates, unit non-response rates in surveys, that has grown over time in the US, as has item non-response in terms of programs like this. So we see more imputation. We also see growing unit non-response in national surveys in other countries as well. Okay, so the income is key sources of income, particularly for those at the bottom of the distribution, are underreported. So these are kind of at the bottom of the distribution, calls into question whether or not there's really a compelling case to say that income is more accurately reported. There's also been some comments about and criticism of consumption at the top. It just says, well, we just don't measure consumption well at the top of the distribution. There's lots of evidence that we don't measure income well at the top of the distribution, particularly in the US, work by Piketty and Saez and others. It's much harder to kind of validate or test whether or not we're measuring consumption well at the top of the distribution. The work that has been done looks at whether or not we're less likely to get responses to consumption surveys for those at the top of the distribution. So Sablehouse and co-authors have a study that looks at what's the average income of the zip codes that are responding to the CE survey, and note that some of the highest income zip codes are underrepresented in the CE survey, but it's really only the very top, so top 5% of zip code income, and so that the underrepresentation is likely to be small. A nice use of administrative data is there's a Brummett paper that links the CE sampling frame, so the consumer expenditure sampling frame, to tax data. So you can actually get the income values for those that don't respond to the survey, and look at whether or not income is a factor in failing to respond to the consumption or spending survey. Pardon me. And it turns out that it matters, but it's really in the extreme tails. So it's the very highest part of the distribution where we start to see that the much lower response rates. They conclude it's not likely to affect things like the 90th or 10th percentiles of the distribution. This gradient in income in terms of non-responses is further out in the tails. Okay, so that's kind of comments about this idea that income people have argued income is more accurately reported. Let me now, because I've picked on income, let me pick on consumption a little bit, and then maybe push back on what others have done in terms of picking on consumption. And I'll just present a little bit of evidence about the diary, because I don't have time to go too far into diary versus recall, but I'll show you some evidence based on that. So is consumption measured poorly? Why had people pushed back on Bruce and I, saying, well, we don't think that consumption in surveys is measured accurately? Much of it comes from data like this, that the Bureau of Labor Statistics and others have produced. It's kind of a similar flavor of what I showed you for income transfers. This is comparisons to aggregates, where the numerator is the weighted total of spending by US households using the Consumer Expenditure Survey. So this is spending. The denominator is personal consumption expenditures from NIPA, the National Income and Product Accounts in the US. So what is the government saying that we're actually in total spending? And back in the 80s, it was about the Consumer Expenditure Survey captured about 80% of total spending, and that has declined. And so it was really this sharp decline that has given some concern to whether or not the CE is actually accurately capturing consumption. So this was kind of the primary evidence that those that were skeptical of consumption were turning to. And so Bruce and I kind of dug deeper into this and done many comparisons of CE survey to administrative aggregates or national aggregates, and that's uncovered a number of kind of caveats to this evidence. So the first is that the data here are really comparing apples to oranges. When you look at National Income and Product Account spending versus CE spending, they're really intended to measure different things. By 2009, so the General Accounting Office did kind of analysis of this, and in 2009, 30% of what's in the personal consumption expenditures measure aggregate is not intended to be captured by the Consumer Expenditure Survey at all. And back in 1959, that was 7%. What are these differences? Well, the NIPA captures all that's produced in the economy that people consume, whereas the CE survey is out-of-pocket expenditures by household. And what's the difference between those? Just a few examples, like NIPA is going to include employer contributions to health insurance. Those are not out-of-pocket expenditures by households. Purchases by nonprofits on behalf of households included in NIPA, not in the Consumer Expenditure Survey, et cetera. So there's a fair amount of misalignment that you don't want to look at the total versus the total. And so what Bruce and I do instead is compare components to components in the National Income Account data. And you can't do this for all components because there are definitional differences, but for many, including the largest categories, the definitions align quite nicely. And so what we do is look at specific components of consumption that are in both the personal consumption expenditure and in the Consumer Expenditure Survey. And here we're just reporting the total dollar values for 1 year, 2010. And we do it for the 10 largest spending categories. And what you see, and I'm going to highlight these categories that are all reported well and are really quite large. So kind of a key takeaway from this is the largest categories that we collect data for in the Consumer Expenditure Survey compare quite nicely to aggregate income accounts or spending accounts. And so, for example, new motor vehicles, if you took this ratio, it's 96% of total spending is captured. Gasoline is 78%, food at home is 86%. This is about 95% for rent and utilities. Owner-occupied housing is actually about 106% when you compare CE relative to the PCE. When you look at these categories alone as a fraction of total spending, it's about 2/3 of total spending. When you look at it for the bottom of the distribution, it's over 70%. So well-measured components of consumption are arguably captured reasonably well in the survey. You might say, well, this is a point in time, and other people have expressed concerns about deteriorating quality of the data. And so what Bruce and I do is do this same analysis for as many years as we can. So this is looking at cars, new motor vehicles, and owner-occupied housing. And if you look at that, what we're plotting is the ratio where the numerator is the CE spending, the denominator is the national income account, the personal consumption expenditures from national income accounts. And kind of the general takeaway I'll emphasize is for these large categories, the ratio is high, close to 1, and does not appear to be deteriorating over time. If you look at rent plus utilities, so here's where I'm going to distinguish between the interview and the diary. We see that this ratio for the interview survey, so this is the they interview the household and ask them about their spending over the prior quarter, so the previous 3 months prior to the interview month. The diary is asking you to record your spending for a 2-week period. And same survey, different households. I can't show you the diary for all categories. It's not, I don't show it to you here because it's not collected in the diary, but when they're collected in the same way in both, I report both. So you see the level is slightly higher for the interview and is consistent over time. If you look at food at home, so it's a very important category. You see that, again, the category is a little bit larger for food at home in the interview survey, the diary survey, very flat over time with a noticeable exception for when the CE changed the way they asked the question and then changed it back. But otherwise very, very flat in the ratio, high, close to 1. What are some of the things that are not reported well? Well, here we're looking at clothing and shoes. That's a category that does particularly poorly in these consumption surveys. The ratio is well below 1 and has been falling over time. Here's an example where it's a little bit better in the diary, but even in the diary, the ratio is much lower than the other components and has been declining over time. Perhaps not surprising. People don't like to report how much alcohol they're consuming. And that ratio is among one of the lowest that we see for the large categories. So some components of consumption not measured well and have deteriorated over time, but there are these large components of consumption or spending that appear to be measured well. All right, so that's kind of my evidence on the data quality issues. And with the time that's remaining, I just want to give you a flavor of kind of how this matters for our understanding of changes in economic well-being over time. And so Bruce and I have done, and others have done some work looking at income and consumption-based measures of poverty and income consumption-based measures of inequality. And also looking at other parts of the distribution. So I'm just going to show you a little bit of the evidence from that. So these are income and consumption-based poverty rates, where we're measuring after-tax income plus non-cash benefits. That's our measure of income that we're comparing to a poverty line. And then we're measuring total consumption. So think about that as total spending in the consumer expenditure survey, but converting spending on mortgages and vehicle payments or new vehicle purchases and converting those to service flows. For mortgages or for owned homes, that's just reporting the rental equivalent. What would your house rent for if you were to rent it in the private market? And so we construct this measure of total consumption, and then this measure of after-tax income. This is from the total consumption for the consumer expenditure survey, income from the current population survey, which is where we measure it for our official measures of poverty. Just in terms of how we're measuring poverty, I'm taking the official poverty rate in 1980, calculating the threshold that would give us that same poverty rate, that's 13% in 1980, if I looked at the after-tax income distribution and the consumption distribution. So what we say is we're anchoring the thresholds in 1980. so that all the poverty rates are equal. This allows us to look at the same distribution at one point in time. And then all we do is we calculate these resource measures over time, and then we adjust the threshold using that threshold that we calculated in 1980 using a price index. And we are using a bias corrected price index. So I won't go into the details there, but if you're wondering why is poverty falling more than you thought you remembered in other research, that's because the thresholds we're using are adjusted over time for a well-documented bias in the CPI in many studies. But that in terms of comparing income and consumption, that is less consequential. So when you anchor the thresholds in 1980, adjust them over time, what we see is that for many, many years, all the way through to 2000, changes in income poverty and consumption poverty are very similar. And then what's happened since then is we've seen a much greater decline in consumption poverty than income poverty. Now, remember earlier that I said that the concerns about income measurement are really, they grow as you go further down the income distribution. When we anchor in thresholds in 1980 and adjust those using bias-corrected CPI, we're getting down to a very low point in the distributions as we get to 2020. Let me do this same exercise, but instead of anchoring at the official poverty rate in 1980, let me do it in 2020, because that's going to move us up the distributions of income and consumption. So here's that same figure anchoring in 2020. So now we're anchoring at 11.3%, the official poverty rate in 2020, and we're just adjusting the thresholds backwards and looking at the extent to which after-tax income or total consumption exceed those thresholds. When you do that, you'll see that these are remarkably similar, right? So the poverty rates, the changes in poverty over time align very closely. So the key takeaway here is as you look further up the distribution, you actually don't have to get that far up the distribution. Changes in income and consumption are quite similar. But if you're going down very low in the distribution, you see that there's actually these differences. And this matters a lot for our understanding of what's happening to the most disadvantaged households in the United States. Putting this another way, we wrote a separate paper that looked at the well-being of single mother households in the United States over a long period of time that spans a period where we changed a lot. We basically reformed the social safety net in the United States. So if you look, in this figure, what I'm doing is plotting changes in after-tax income at different percentiles, actually for different deciles of the distribution for single mothers. Okay, so this orange is the bottom decile. What is the change in the bottom decile of after-tax income over time going from 1984 to 2019? And what that suggests is that we actually have seen a close to a 12–13% decline in real income for single mothers in the bottom decile of income. If in contrast, the top half, you see some growth over time in real income, right? So it's the very bottom. The single mothers are already disadvantaged. If you look at the bottom decile of single mothers, these are perhaps the most disadvantaged, and it suggests that they have been made worse off over time. If you look at consumption, it's a very different story. The bottom decile of consumption for single mothers over this period actually has enjoyed more gains than you see for the top half. Okay, so that this emphasizes the point that where we're really seeing the differences for income and consumption is at the very bottom of the distribution, precisely where we see these sharp differences in levels that have given rise to concern about the validity of income. This then leads to kind of a natural. It's probably not surprising if we look at inequality this is the 90-10 ratio for income and consumption, and what we see is a much sharper rise. And really, again, it's in this later period after 2000 where we see a rise in the 90-10 ratio for income, but little change, maybe even a decline for consumption. When you decompose this, this is because the 10th percentile of consumption is rising while the 10th percentile of income is not. Let me just take 2 minutes to kind of give you a sense of where things are headed for future research, and then I'll turn it over for questions. The main point that I want to make is that there's a lot of work going on that is currently linking survey data to administrative data to address concerns about misreporting of income. Bruce Meyer has spearheaded this initiative called the Comprehensive Income Data Set, where he merges many nationally representative surveys that collect information on income to administrative data like taxes and government programs, like I've shown to you at the micro level, so at the level of the observation of the household or the individual. Some applications, looking at examining the effect of transfer income on poverty after adjusting for underreporting. So I showed you that surveys underreport income. What happens if we adjust for that underreporting in terms of our understanding of the impact on poverty? I'll show you some evidence of that. Bruce and I have a separate paper that looks at whether or not the differences in income and consumption at the bottom that I documented and showed with you can be explained once you use administrative data sources. So replace the, say, income response for food stamps with what the administrative data say that household shows you. So one piece of evidence there is if you look at government programs and look at survey data only, it's the Social Security, food stamps, this is the tax credits, earned income tax credit, housing subsidies, and supplemental security income. This is the percent of reduction, increase in poverty if you take this component out of income, right? So poverty if you take out Social Security, poverty goes up by 48%. But if you also include or you use administrative data combined with survey data, poverty goes up by 78%. In other words, just using the survey significantly understates the impact that these government programs are having on economic well-being, in this case, reductions in poverty. You see that in terms of the impact that food stamps or SNAP is having, all of these government programs. And so I will stop there. Given that we're running close on time, and turn it over to questions.
Okay, thanks very much, Jim. That was an amazing tour de force, a really good overview of all the work you've been doing in this area, and really relevant to, I know, a lot of people here and around the world as well. So yes, now it's time for questions. As I said, so if you want to ask a question, if you just type it into the Q&A box, and then if we have time, we'll pick it and ask you to unmute yourself and ask your question. We already had a few questions asked during the talk. So one is from a kind of deep conceptual question, which is from Daniel Daz, who said he also might not be able to stay on the call, but he's still there. So Daniel, do you want to ask your question?
Hiya, can you hear me?
Yes.
Great. Yeah, so yeah, thanks very much, Jim, for the presentation. It was really interesting. Yeah, basically just, yeah, as he says, quite a foundational question. What's the definition of economic well-being that you're using? So sort of what are you trying to measure with income and consumption? What are you trying to get at?
Yeah, so I think that, you know, we have in mind a utility function that we're measuring well-being in that sense, but acknowledging that neither income nor consumption captures all of the aspects of utility, you know, and that's where the multidimensional measures of well-being, I think, are critically important. And perhaps maybe at the bottom of the distribution in particular, you know, where we're not capturing things like health, mental health, you know, capacity, capabilities to choose your jobs, and you know, we're not capturing leisure either. And so I think economic well-being based on the resources, what you actually consume or the resources available to consumption is what we're trying to capture, and acknowledge that it misses a lot of what we might put into a utility function.
That's good. Can I ask a related question, just almost a follow-up?
Go ahead.
Yeah. So yeah, you mentioned actually their capabilities, and I was sort of wondering, have you thought about, I think maybe I've interpreted this wrong, but one of the main differences at the very bottom of the distribution is, benefits, income that I haven't necessarily earned through a job, but that I've received from the government. And how does that, but we may think that actually earning your money or working and getting a wage, there's a value and almost a value in autonomy and being able to do that. And if we start to focus, say, on these consumption measures, we may miss that. Or, in the very extreme case, you end up with people not working at all and just being given money, and that's actually not good for a person potentially.
Yeah. So I put this. It's really good point. I put this in the category of a limitation for both income and consumption, and so a nod to maybe wanting to explore other indicators. We've actually gotten a pushback on this in both directions. So one is that the intrinsic value of work. That I think you're touching on, that's important, that's not captured here in either measure. But the other is on the other side is leisure, right? Is that we're not, if you have to work really long hours and commute to get to consume at that level, in consuming very low levels of leisure, we're missing that as well. Bruce and I have done some work trying to incorporate both leisure and consumption into a measure of economic well-being. We run into that same challenge that it's not in the same data set. But one thing you can do is that it turns out that most of your time in a time use survey for adults, or not a large fraction of your time, and the variation of your time can be accounted for by your time in market work. And so you can impute leisure reasonably well, using data on market work, which we do see in the consumer expenditure survey. The time variation in home production adds a challenge there. But I think that those are really fruitful areas for future research, is trying to incorporate those other components of well-being that are not captured here.
Cool. Thanks very much.
Yep.
Thank you. So we've got some other questions. I'm going to try and group them because some of them are sort of cover similar themes. So Martin Wheel, he's not really a question, but he says it's surprising how similar the UK and the US are in terms of the coverage of consumption data and underreporting of income. And then there's another more specific question by Catherine Kent, which is, are there any reflections on why on clothing in particular might be reported poorly? But I'm sort of interpreting this as a general kind of, what's going on, and there seems to be an international phenomenon. So what's driving this deterioration in data quality in those areas where it is happening?
Yes. So we know very little here. I think that this is a very fruitful area for future research. I can offer a few reflections. One is it does appear that larger categories that are consumed regularly are reported better than smaller categories that are purchased sporadically. And there it might even be, not too surprising that the diary captures clothing better than the interview, because you just, over the last 3 months, I don't remember when I went to the store to buy some clothing, but I remember it if it was in the last week. And so, but why it's declined over time, let me get back to that. The other thing that we've noticed is that there are some categories of consumption like alcohol. I didn't show you tobacco, but tobacco is also very poorly reported. That seemed consistent with people who just don't want, aren't being honest with themselves or don't want to reveal that. That also, by the way, there's some anecdotal or suggestive evidence that individuals don't want to report income that where there might be a stigma associated with it. So that's worth noting. The decline over time, let me make, the data are actually even worse than I've showed you, because if you look at unit non-response, so not responding to the survey at all when you're called, that has gone up over time. And then if you look at item non-response, so conditional responding to the survey, what's the probability that you actually respond to a question? That has gone up over time as well. And we don't have a good answer to that. We have conjectures, one of which is that the frequency of which households or individuals are asked to respond to surveys, it has grown considerably over time. And so individuals perhaps trust in them or assessment of the merits of responding to it maybe, or they simply have just grown tired of it. And so, when I go to the doctor, I get a survey. When I go to the dentist, I get a survey. When I get my tech support, I get a survey nowadays. So there's something like that. It's really striking when you look at. I think we ended up getting data from about 6 or 7 different countries on large nationally representative surveys and for unit non-response. And we see that it's a decline over time for all of them. And so it's really a striking challenge. I think it elevates interest in things like using administrative data to supplement the surveys. Administrative data is not going to replace them, but understanding how we can use them to improve quality, I think, is really important to future research.
Thank you. I'm going to abuse my position as chair to ask my own question, which is, I guess a lot of national statistical institutes here and elsewhere are thinking, these consumption surveys, they're costly to implement. It's becoming increasingly difficult to get people to participate in them. Can we look to, running them at lower frequency or streamlining them, asking a reduced set of questions and those sorts of things? But I think, one of the things that your work really shows is the really importance of some of this survey data. So do you just have thoughts on the kind of future of consumption surveys and what's important to include and what's important not to include and where we should be going?
Yeah, my point about the large categories that are frequently, where purchases are frequently made, are reported better, is some indication that you could get similar quality consumption data asking fewer questions. There comparisons of the panel study of income dynamics consumption questions in the U.S. to the consumer expenditure survey suggest that as well. We could perhaps reduce the number of spending categories, and that might help. The point you bring up, though, is particularly important when we think about the use of consumption data. And so consumption data tends to be collected and released much more slowly than income data for a number of reasons. And that makes it really difficult to use it as a kind of real-time indicator of how well we're doing. And so we already released some of the income data too slowly to make important decisions, and perhaps there's no better example of the cost of this when with the pandemic, when you have dramatic swings in government policy and economic circumstances, but we don't really know what's happening to the income distribution and or the consumption distribution for that matter. So I think finding ways to do it at greater frequency with perhaps a less taxing survey is something that is really worth investigating. And the Bureau of Labor Statistics here in the United States is looking into that. one of the things I didn't get to in my comments is that they are a recent working group proposed adding consumption-based poverty measure as one of the metrics that we follow, not to replace income, but as something that we follow. And to do that, we're really going to need to measure, collect it for more households so that we can get more precision, and to do it, release it more quickly.
Okay, thanks very much. And that brings us to the end. So thanks very much, Jim, for the great talk. Thanks to the audience for coming and for your questions. And we've got another ESCoE seminar in 2 weeks, which will be Max Nathan talking about the new wave technology diffusion in the UK during the 2010s. So sign up for that. Thanks, everyone. Bye.
Thanks.